Welcome to the next video in our Forex trading strategy series. This is the proven formula for finding winning opportunities. Okay, there's no one formula that beats the market, but we know that every trade we make is precious and every little edge matters in this highly competitive market. The key to maximizing your odds is not to go after every opportunity, but rather to realize when probabilities tip in your favor and then to take action accordingly. So many of you are probably wondering right now why I had a cheetah picture earlier, and the reason why is as follows. When the rest of the market is displaying a weakness or sentiment is shifting, which we determine objectively, and I'll show how to do that in the next post, then we pounce on the opportunity like a cheetah does after stalking its prey patiently, so that we're ahead and can ride the wave for maximum profit. So here's the formula that I utilize when looking for trade opportunities. Imbalance plus sentiment shift equals predictable price move. That's it. If you can satisfy these two requirements on the left side of the equation, then you have maximized your chances of success. So what does this formula actually mean? Have you ever heard the terms market correction, recovery, or pullback? These terms represent when the market makes a move to correct something that has gone fundamentally wrong or things have gone out of balance. And since the Forex market consists of different types of traders, all with different types of objectives, imbalances will always develop. For example, the pound may be going up due to investor optimism in the UK, yet economic indicators may show otherwise. They may show that the bank lending may still be terrible in that country and thus signal that the economy is still stagnating and hasn't really recovered yet. Or if we take commodity-based currencies such as the Australian dollar, if we see that the Australian dollar has been confined to a range, it hasn't moved much in the positive direction or negative direction, yet correlated assets such as gold have been climbing really fast, we know that some kind of imbalance is developing because those are usually supposed to mirror each other. In each of these descriptions, one thing doesn't agree with the other. This is an imbalance and is a valuable clue to trade Forex successfully. Locating imbalances is critical to picking the right direction for a fundamental/macroeconomic style trader. Sentiment is a term used to describe the market's general feeling of a currency. Remember, this is the second part of that equation from earlier. You may have heard people describe themselves as either bullish or bearish on a currency, and this is a reflection of their sentiment. The reason why I stress sentiment in Forex so much is because the chaotic nature of the market and its complexity suggests that in the short term it does not move with the fundamentals like it should, but rather with the ebbs and flows of sentiment. Okay, that's really important to realize. It doesn't necessarily move with the fundamentals, which usually govern its price movement over the long term, but rather the ebbs and flows of sentiment in the short and medium term. Sentiment may be influenced by news releases, rumors in the market, and technical levels, and it can be recognized typically by observing price actions to surprises in scheduled economic numbers released every week, commitments of traders' data released by the CFTC, it's a government organization in the United States, and also media headlines and bank report headlines, as well as clues from other markets that are related to currencies such as the VIX and Eurodollar futures. And we'll get into more detail on how to specifically identify opportunities using these different tools later. Now, the purpose of using these two components, imbalance and sentiment shift, in our above formula is simple. We want in our Forex trading strategy a powerful driving force or reason to support our direction, so if our timing is off, it doesn't matter. So many Forex systems emphasize getting the timing right with all these special technical indicators, but in the end nothing can fully describe the chaotic nature of the market in the short term. Instead of timing the market, put the odds in your favor by waiting for an imbalance to happen. And there's no need to wait long to see these imbalances. They happen almost monthly. And once we see these, we utilize the second component, sentiment, by aligning ourselves with the immediate directional swing in the market. Plenty of people spot imbalances, but they get in when the market is moving the wrong way, thinking it should reverse, and they keep holding on to it and holding on to it and holding on to it, and eventually they lose a lot of money because they're over-leveraged and can't hold on to the trade so long. So economists are famous for this. Have you ever heard of the saying, economists predicted 8 out of the last 3 recessions? My point is, wait for the market to start correcting in your direction before getting in. Don't fight the market, move with it. So keep these steps and the formula in mind for your Forex trading strategy. Over the next series of posts, we'll go over the strategies in detail so that you will eventually be prepared to trade with this Pro Forex method successfully.